Hello and welcome everyone. Thank you for joining us for this month's Investor Academy session. I'm Sarah Turner and I'm joined this evening by Simon Hopkins, who's my co-founder, and Michelle McQueen, our network manager. And of course, our two brilliant speakers this evening. We have Zoe Peden from Ananda Impact VC and Jodie O'Keeffe, one of our very experienced angel investors. As usual, to talk to us and ask questions, please use chat. Just a little bit about us before we start. So apologies to those who've are regular attendees, you'll have heard all this before, but Angel Academy exists to close the gender gap in startup investment. Both the lack of investment going to female founders, and Bowhurst have just released their latest report, which says that this gap is persistent and not going away, but also we're addressing the low number of women angel investing. So we're a mainly, but not only, female network of angel investors. And so far, our investors have backed over 40 businesses, and that's through more than 60 rounds of investment. In 2021 alone, we invested in 15 startups and helped those businesses attract collectively nearly £20 million from angels, other angel networks, VCs, EIS funds, and family offices. And we've just completed 2 follow-on investments, both at Series A. So many of our portfolio companies are scaling fast and the year has already got off to a good start. We're really lucky to have some great sponsors supporting us. They advise us as investors, but also the founders that we back. If your company would like to get more involved, please let me know. But for now, back to tonight's fun. So I'd like to invite Zoe and Jodie to the stage to introduce themselves and start their conversation. They're going to talk between themselves for a bit, but we'll leave plenty of time for your questions. So please put them in chat as we go along, and I'll come back on screen later to pose those questions. So over to you both.
Okay, thank you, Sarah. And hi, Zoe, welcome. Thank you for coming along, chatting to us tonight. So everybody, you've probably heard me introduce myself a million times as well, but I'm Jodie O'Keeffe. I've been with Angel Academy for about 5 years now, and angel investing for a bit longer than that. I've got about 17 businesses in my portfolio, and some of those I've followed on with, so multiple investments in some. And my investment thesis is fairly sector agnostic. There's a few things that come into it. It's idea, it's founder. Often it's something that appeals to my values, which I think it fits in with the theme of impact investing tonight. But I think, you know, we'll talk about this in detail a bit later, but I have the freedom to choose. So as an angel investor, it's my own money that I'm spending. And so, you know, I can set the rules or I can change the rules depending. So I'm fairly sector agnostic. But you know, technology underlies a lot of them, and we do like SaaS B2B at Angel Academy. So I've got quite a few of those. Just looking at a few of them listed. I've got some med tech is a fairly, you know, features fairly prominently. Some HR technologies, a marketplace. I've got what else? I've done the soft drink. I've done Nicks and Kicks and that kind of thing. So there's a really broad range. Yeah, so that's me for angel investing. I'm also involved in philanthropy. So I've got a family foundation, mainly operating back in Australia, but basically does a similar thing. You know, it's obviously more impact focused and it's not for profit. So not expecting any high financial returns, really just mission fulfillment. So, but, you know, I see the both support one another. I guess it's impact investing one way or the other, whether it's with female founded businesses or whether it's with the philanthropy. So that's me, and I'll hand over to Zoe now and you can do your intro.
Thanks, Jodie. I'm Zoe Peden. I'm principal at Ananda Impact Ventures, and I lead investments mostly into B2B software, actually, so not too far off Jodie, in terms of business model across the UK and Europe. I look after the UK and the Nordics. The rest of the team, mostly in Germany. That's where Ananda was born, effectively. We invest across a number of different areas. So digital health, sustainability tech, lifelong learning, and tech that encourages equality. So we invest from C to Series A. Initial ticket size tends to be between 1 and 3 million. And we can invest up to 15% of the current fund, which actually it's just grown. So it's 110 million euros, the current fund. So I guess it's over 15 million. We can do, through the lifetime of the funding requirements. And we've got 4 funds over the last 12 years. But all the partners and myself have all been founders ourselves. So we've built companies. So we always see founders at eye level, but it's all about impact, and impact in Europe, not developing countries. So in our backyard, as we say.
Okay, great. Do you want to give maybe an example of 1 or 2 particular businesses, just so we get a feel for what you look at when you talk about impact?
Okay, so one of them is from the second fund, so it's quite mature now. It's just raised $53 million Series B, i.e. So Digital Health, which is online CBT. So we liked that one. We've invested 7 years ago now in the seed round, so very, very early on. And we like that because of the data set that they had. It's quite unique. It was before everyone else was doing teletherapy. So they've got the biggest database in the world of data around online CBT. So it's quite unique, very unique data set. That's what was really exciting about that. And then another one that was done in Germany quite recently is called CLIM. And what we look for are founders who are going to change an entire industry, and this one's around regenerative agriculture. So what they're doing is trying to work with farmers to change the way that they are doing farming to be more sustainable and retain the carbon in the soil. So getting the funding for that around carbon credits, but also having a label, a clean food label off the back of it too. So it's got multiple business models. So changing the entire industry and the supply chain towards it is really interesting to us. So those are quite different, totally different areas, but for us, incredibly impactful, whether it's systemic impact or healthcare outcomes that are quite measurable as well.
Yeah, okay. That's great. You must have so many interesting businesses coming to pitch to you, I can't imagine.
Yeah, it's fascinating. It's your head just explodes.
And I imagine you'd want to invest in all of them. They've all got something positive going on, I'm sure. So
yeah, no, it's a tough job, but someone's got to do it. No, the founders have the tougher job for sure. So,
yeah, I think you might be very busy at the moment. So I'll give a couple of examples of, I've name dropped a few that I have invested in, but to go into a little bit of extra detail. So I've invested in Enterprise Alumni, which is it's HR tech, I guess you would call it. So it's basically ERP in the suite of modules that ERP systems offer. There was something missing out of the HR module, which was the alumni management. So Enterprise Alumni came along to us and pitched. It was probably in 2018, I think. So we've been holding them for a while now, but that was a Series A round, and we're looking at their Series B at the moment, so or a bridge to Series B might be more accurate. So I quite liked about that business. I liked the fact that there was just this like blatant unmet need in the market. Like it was just alumni was something that universities had done a little bit and not very well. So that was just an obvious something, and they already had some good early traction with companies like SAP. So someone like SAP, who are an ERP system provider, are buying this extra module. It really bode well. So that was one of them. But one that's more recent and more of an impact, I would say, is DemDX, which
that's a good one.
Do you know that one?
Yeah.
Yeah, so I invested in that one just at the end of last year. It closed, and I think in terms of being a great business, but also having an impact. So it's basically an app where it helps healthcare professionals, so not necessarily doctors, but it'll be the nurses and the people that are sort of triaging to go through and do a whole bunch of like diagnostic tests or go down a pathway that a doctor would normally do. So it's AI basically supporting a diagnosis earlier in the flow of medical care. So, you know, that one I liked. The founder was fantastic. Lauren was very impressive. And just, I really think that we can use technology to ease the burdens that we've got in things like healthcare. So that was a good one. So I thought in terms of impact investing, and especially after COVID, I think medtech has really come a long way. So what have we got next? What are some common themes that you've seen in successful businesses?
Gosh, yeah, definitely the you know, you can't get away from founders, the team.
Yeah.
Just something quite different. You know, having been a founder myself, I know you toe this line between people thinking that you're crazy, but the sheer extra bit that you have to put in to drive things through that people say is not possible, you're almost, you know, you can come across as slightly crazy. There's something extra that person needs to know, that they're going to have, there's going to be so many barriers in the way, but they're very good at you know, they've already had evidence of getting through quite a few of those. The working, you know how to work at an international level or utilize the networks to grow internationally. There's always, yeah, something just that little bit extra. I think a sparkle we're always on the lookout for. And then because we can go in, you know, sometimes working on Series A plus one, so a bit like your Enterprise Nation, you know, that stage. At that point, I'm looking. It's really important to get aligned investors too, because on that journey towards the Series B, it can go wrong. Not everybody makes it. So people who have aligned values, aligned on the business plan and the direction and the way that they're going to grow, because that can, if they're not, it can be quite destructive at any stage, but particularly that one. The founders, investors, just everyone around the table being aligned, and just some clear distribution advantage. One of the most frustrating things, particularly in medtech, is when you see magnificent products, but they can't get them out the door. And it is so frustrating to see that. So having access through maybe where they've worked in the past, they come from that industry, some kind of advantage that other people don't have to the distribution. Because yeah, there's nothing more frustrating when people got an excellent product and it doesn't sell.
Yeah, I agree. Actually, that does seem to be an issue, doesn't it? And so one of the things that I had in my points for that was I do like to see a founder who has previous experience in the industry. So, you know, that goes so far in terms of just understanding the problem, understanding the unmet need, and having the contacts to be able to sell through, you know, and it's often a snowball effect. If you've got one or two champions that you've worked with before, or that, you know, can connect you to the right people in that industry, it can really make a big difference in terms of how successful you are or not. And because
speed, you know, isn't it? They can get there quicker.
Yeah, get that traction and get that snowball rolling, you know, that's what you want. But yeah, I agree. Particularly those medical, you know, the innovation is so impressive and inspiring, and you really, as an investor, I really want to back that, and I want to see that change in the world. But then if you're coming up against this like systemic, you know, oh no, not right now, we don't have the budget, or, you know, those kinds of no's, it's really frustrating. So yeah, I totally agree with that. I've seen that. I also go as at sort of that earlier stage, I like to see founders who also have a good co-founder. So a good strong team. Because I was looking through my investments and I was thinking, okay, the ones that are doing the best, what have they got in common? And actually that I hadn't thought that through before, but that's what they've got in common, quite a few of them. And often with the female founders, if it's two female founders, they seem to be you know, the dynamic is just very supportive, and they understand each other, and they know that what hurdles they're coming up against, they can, you know, inherently understand them. But also if there's you know, and Simon and Sarah would vouch for this, if you've got a strong male co-founder as well, who understands what you're up against as a female founder, I think that really helps. So those seem to be the ones that, yeah, definitely the founder and the supported founder. And I think we've spoken about this a little bit before, was having support as a founder in terms of your mental health and you know, having balance in your life. So I hear what you're saying about you have to be a little bit crazy, but I would probably translate that into having tenacity and having a never say die attitude. But I think that, and you would be able to speak to this more, I think you have to balance that with this is a long haul. Like you're going to need that energy for quite some time.
Yeah, I mean, founder burnout's been quite a big topic recently, hasn't it? Especially during the lockdown, making sure. And we have a founder health clause in our term sheet alongside the diversity and inclusion and carbon reduction and our, you know, impact clause as well. We we have a founder health one, and we insist that if our founders don't have a coach that's not just performance-based, but somewhere, you know, someone that they can speak to about what's going on in their life, then they need to get one, and we insist on it. Wow. Because it's really, really important for your development, you know, as the management team, as the founders, to get through those 10 years. It is a long haul, isn't it? It's people just don't come into it thinking about it like that. It's going to be a good 10 years of your life, possibly longer. And you need to be in good shape for that. If you're not in good shape, the company won't be in good shape. So it's really, really important.
Yeah, and I think, I can't remember the statistic I read, but something about the main reason that startups fail is it's people related. The problems can be people related, that there's founder fallout, or there's burnout, or there's, you know, problems at board level, problems with investors, you know. So there's a lot of that stuff that's, it's you know, personal growth, or just just feeling calm and confident within yourself so that you can tackle all this other stuff that's definitely coming at you as well. So I think that founder mental health clause is, you're probably I haven't heard of anybody else doing that, but I think that's actually a really good one. We do that with Angel Academe. We do talk about with founders making the fundraising process as, you know, stress-free as possible. So we try to just have a deal lead to be the main contact in the fundraising process, just to keep things as simple as we can. We try to do it as quickly as possible, and we try to just do the due diligence that's commensurate with that business at the time and the stage that it's at. So we try not to overwhelm the founder with, you know, coughing up too much information or having them scramble for it when it might not even exist at that stage of the business. So we try to keep, try to help them keep focused on the business and making the business successful, and not be too demanding as investors. So
yeah, when we do, actually, you know, topic of due diligence, we are quite thorough. We have to be as a fund, because they're going through, when we invest, the rounds are fairly hefty, and we want to make sure, as we do our due diligence, it's not just to make sure that people are telling us that the right, you know, it's actually there and it's true. We're trying to help them on what they might need to do next, look for the gaps, or where, you know, ways that they can strengthen. And often we send in our experts. It's not just us doing the due diligence. We send in a tech one, a firm. We have a HR one that looks at, you know, across the company, and does surveys across the company, as well as leadership interviews as well. And we also do on the finance one, which is much more straightforward. That's looking at the accounts. But the tech and the HR ones are there to inform them and help form the next 12 months and what they need to do. And the founders, although it's intense at the time, the value that they get from them, no one's really ever looked at them that closely when we go in and do that. And it's been really, really appreciated. But we do tell them how much time it's going to take. We make sure it's spread across the team, that it's not just the CEO, because the CEO tends to get everything. And we make sure it's, you know, it's spread across. But yeah, it gives incredible insight on what needs to be done, and really feeds into the plan. So like invaluable.
Yeah. How long does it normally take for you to complete your full due diligence?
It's all like how long is the process itself. You get faster rounds and you get slower rounds, but when we put our external people in, it's going to be at least 2 weeks for them to write it. It's not 2 weeks with the team, it's like half a day or a few hours, but for them to do the work, to go out into the companies and then come back and write it up and then disseminate to us and then back to the company as well. Yeah, it's a process of 2 weeks. So it's not too fast.
Those specific deep dives. Yeah. Okay. And then what do you think about the fundraise altogether, like your investment from sort of deciding that you're going into due diligence with a business to, say, closing that? What's the average? I know that it varies. But...
The thing that I find varies the most is whether, because we'll lead or co-lead. If we kick it off, obviously we're quick on the term sheet and getting our DD done. If there's co-investors and it's a larger round, that's what takes time, bringing everyone else in, herding everyone and getting the right investors around the table. You obviously share your due diligence with what you've done so far, but there might be extra ones that their investment committee want them to do. And that's out of your control. You try and speed it up as much as you can to keep within the founder's timeline as the lead. I'm sure you do as well, when you're leading. But there's quite a number of things that are outside of your control often with other funds. But timing, anything from 6 weeks, the fastest, to 6 months.
Wow. Yeah. Yeah, which, it sounds like a long time, but it's not that uncommon, is it really? By the time things get delayed, and if you have a summer in between or something like that,
summer and Christmas destroy timings. Yeah,
correct. Yeah, Christmas. Yeah. So, we try to. I mean, that makes me feel better actually, because we, all the founders that we deal with, they want to get that done quickly, and sometimes if we say from the outset, oh look, we're looking at 6 to 8 weeks or 3 months or something, it can put them off. But even if you say it's going to be shorter, it still ends up being that amount of time in the end, so I try to encourage founders, first of all, in these kinds of chats, it's like, well, it's going to take longer than you think to raise funds. So, plan ahead for that. Don't be desperate, because things are going to get pretty crazy toward the end if you're running out of cash and trying to inspire confidence in investors at the same time. So, the timing of the fundraise is really important. But we do try to keep things quick, but often we'll be not the lead of the round. We'll just be following on from a VC, but it might not be a VC. It might just be an EIS or an SEIS fund, which is I would say a slightly different story.
Yes, I think they're a bit quicker. They have they're doing more investments per year, so we'll just do 5 or 6. So that's why we'll sit on the board, and it becomes a big part of our lives. We don't have that many each and we focus on them really hard, whereas I think some of those EIS and SEIS funds, they do 20 a year, and so they've got a process.
They're moving through, but they're the ones we're often waiting on. Like, we might get our soft commitments or even our firm commitments worked out, or having done the due diligence, and then often it's tweaking the term sheet that seems to take the longest time at the end. It's like the lawyers.
And that bit's frustrating, because as a founder you think you're there, but you're not there, and every 24 hours seems like pain, and it's you can feel it with the messages, all the WhatsApp messages
the
from
emails,
the founders.
That's right.
It's like there's very little, there's so many moving parts, and getting everyone aligned on that final bit, it's always painful.
Yeah, that's right. And you can be there, 90% of it's all done and everybody's aligning, but then that last 10% can just drag on and on. Which is a shame. I feel for founders when that happens. You can see that they're just ready to get their funding and to get going, but it just keeps on dragging on. So now, so in terms of financial returns, what are your expectations of your funds, and how is that realized? How does that usually come about?
So we expect to return between 2 and 3 times with the fund. So I think it's slightly lower than more commercial ones, maybe 3 to 4 times the fund. So patient capital.
Does that have to do with impact investing, or just patient, would you say?
Where we've got the money from. That's what we sell to them when we investment. We will make this impact, and these are the returns that we will, promise you. Well, we'll try to deliver, but we don't promise to do the 3 to 4 or the 5 to 6 that some of them do, because that, especially on a fund this size, that's really hard. Really hard. The bigger your fund gets, doing those 4 or 5 multiples, that's I think that's not pleasant environment for me to operate in.
No.
Because you're going to have to be so strict. Not much room for benefit of doubt if there's a blip or a pandemic or anything like that. You got to cut your losses. It's strict VC anyway to make those returns, but so 2 to 3 is fine by us. It gives us a little bit more leeway, and we can be more supportive to the founders through some trickier times without that threat, the die hard, let's cut them off. Because I've seen that with some other VCs, and we've stepped in to have to cover them because they've got these strict, much higher return level expectations from where they've raised their funds. So yes, it just makes us slightly friendlier. Venture capital. We still have to do the returns, so we can't back everyone regardless of what happens with their fund. They still need to be doing well and demonstrating that impact's coming through more sales, and that you can have an impactful business that's also a unicorn, or whatever you want to call it.
So do you find that your LPs, do they seek you out because you are more patient and because of the impact? Is it like a conscious choice?
A conscious choice, definitely, in the way that we sell in. We are definitely trying to differentiate by having this USP and attracting certain types of investor, which has changed over time when your fund grows in size. Like this last one, we've got a lot more institutional. But what's interesting is that banks are actually more interested in this area now. They weren't 10 years ago. So we've evolved, the fund's got bigger. You get more business savvy, I'd say, as an impact investor. You grow over time, you mature, but also the investors who invest in us have changed. And this is good. It's a good direction, basically.
I agree. And I think it's probably being fueled from the ground up, so that the bank's customers are asking, can we please have investments that are going to be more conscious, and they have sustainability goals and impact goals and that kind of thing. So they need to have, I feel like they've got a whole smorgasbord of funds and investments to offer, but there's definitely that one is being asked for more and more. And so, it's a good thing. And hence you're growing and, and the follow-on effect. So it's good. So in terms of financial returns from us as angel investors, though, so it can be quite random, but it's good to put some metrics on it, I guess. So I would say I'm looking at like a 3 to 4 times return. If I got that, I'd be ecstatic, though, to be honest. I'm investing for financial reasons, obviously impact as well, but when I invest, I consider it as it's not a sunk cost, but it's money that I can afford to lose. So it's not going to impact me on a daily basis, and it's a long journey. So I've been doing it for 7 years or something now, and I consider myself lucky that I've still got 14 of the 17 businesses that I've invested in that are still in with a challenge. So I consider myself winning along the way, and also in terms of just meeting people, learning, participating in the whole ecosystem, having an impact by backing female founders, I think is another way of having an impact. So I feel like there's a lot of benefits along the way. So the return, if there was a 3 or 4 times return at the end, like, I would be ecstatic.
Wouldn't it be great? And I think it's important to point out, we've got like a power law, because we both operate on a portfolio basis, don't we? You do as well. Like you were saying, you've got all these different bets, investments across. So we generally see, so we invest in 20 from this fund, and we might see 2 of them actually be outstanding winners. So they'll be the ones where we get our 2-3 times from, and then about 30% in the middle. So maybe 0.5 return, or maybe slightly better, and then 50% either lose or return less than what we invested. So you've got a lot of losers in there. It doesn't always work out, and you have to embrace the failure.
Yes.
And the same for you as well.
Yes, I think you do. But it is a challenge, like what to do when things go wrong. But yes, as an investor, I embrace the failure. I know that most of these businesses are probably not going to be amazing successes. Some of them are going to just, have to shut down. But when it happens specifically, when that business is going through that, I do still find that a challenge, because you think that every business that you invest in is there with a good chance. So there is that disappointment that, it didn't work out. And I think the only, the silver lining is to learn what happened there, try to take that on as an investor, and the founder will take that on their journey, no doubt. But just, I don't think we've quite got to the US model where failures are worn as a badge of pride. Like I haven't quite embraced that myself as an investor. How do you see failure, and how do you deal with it?
I mean, one of the most difficult things, I think, is when you see this failure, not to take it with you into the next investment decision as much, like be tainted by it. Just because this one didn't work, it means that this one won't. There's an element that you take, like, was it the business model? What did we need to do? But they're not all the same. And it's so hard because, we work so closely with them. So it's quite emotional too, when things don't work out. So you remember all this, and to take it into an investment committee and not feel that, I think is really, really hard. That you've got to like scrap everything that went through, this is new, this is a different time, it's different people, and not be hindered by that. And I think that's really hard, not to take your baggage with you, I guess it is.
I agree, actually, I agree. Look, I don't know how hard I try actually to not take my baggage with me. I think I'm taking it along as experience, and then I spot a business that's very similar to one that failed. I'm like, oh no.
I know, yeah.
Straight away, oh no, I've seen that. I try and check
myself, like, oh, you're doing that, Zoe, that no, this thing could, take it back.
You really try to have an open
I try,
mind
because I feel it, in my head.
I know.
Don't.
Yeah. But I think you can then, as a good investor, you can take that experience, and as you're doing the due diligence, you've got the right questions to ask.
Yeah, most definitely.
And you've hopefully maybe learnt some ways to mitigate whatever that risk was.
It just takes so long to learn though, doesn't it?
I know.
That's one of the most painful things. 10 years to know whether you got it right. Great.
It's really learning the hard way. It really is. Yeah. So so I figure the longer I'm in the game though, the better I'll get at it.
That's what I'm doing.
The more failures, the better I'll get. I don't know. I hope. Okay, so moving on then, how do you define and measure impact?
The big one. So this is something we've been working on over the last 12 months quite a lot, and I've seen there's a few questions in there too. So we do use the impact management project as our basis. So we will start with a theory of change, then use that framework to be able to dig deep into all the different areas from that theory of change, looking at what the entrepreneur wants to do with that business, what the eventual outcomes will be, the change, whether it's to society or the planet, and then what the outputs in the middle as they're going on to make that change, what they will be, and build KPIs around that. So we'll have between 3 to 5 initial KPIs, 3 for the very early ones, you don't want to overload them. And these KPIs are very business driven, so they're not in the way, there's no like massive piece of impact work. And in fact, the entrepreneurs often enjoy doing it, and they're often KPIs that they have already. They've just never considered them to be impact KPIs. So they might be around reach, a very important indicator. And then in healthcare, obviously, and in education, just healthcare outcomes or efficacy or some kind of improvement to the individual, or if it's an environmental one, depending on whether it's carbon, whether it's water, or whether it's some other measurement that's more accurate for the company at that stage. And then these get looked at over time, and they get more nuanced. and more related to the eventual outcome, which is where you want to go, the big change that you're trying to do. So yes, we do have a framework, and I think lots of other impact investors do as well. Works for us. The founders really like it, and that theory of change goes into the term sheet, and those KPIs are agreed upon in the investment agreement, and they're quarterly, and to our annual report as well. But like I said, they're defined, they're business driven ones too. So one of them could be like NPS score, which you might think, what's that impact? Well, it's a future indicator of the growth of the business. So, and because the businesses we back have got their impact baked into them, they're not add-on CSR.
Yep.
Through selling more, they are having more impact. Yeah. So the KPIs are all business driven.
Yeah. So that's interesting, isn't it? And that's the key, isn't it? Is to get the business model where the more revenue they generate, the more change the more impact.
And making sure that continues, because we have these, that we have like a theory of change in there, and make sure it's in the articles, so that if the founders decide to go on to do something else in the future, because we're with them for a long time, our money's in there for a long time, then the ethics and the mission behind the company does not change, to go into areas that are non-ethical. So maybe it's a safety tech one being used for by the army or defense or something like that, which would be like, ooh, for impact investors, we need to get out of this. So we make sure it still remains in there, and it's part of the DNA, that making sure that it's in the product, it continues to be in the product as they grow, because they can lose a bit of sight, 5, 6, 7 years in. People start to go in, different people join on and go in different directions. So we're there to stick true to what the founder originally set out to do. I think that's really important.
So how do you handle it if they need to pivot or do your businesses
not out
pivot?
of impact? No, because the way, because it's baked in. I mean, if we make it's in the articles that they're not allowed to do, they have to start doing something that's entirely different, and then we're allowed to withdraw our money. And it's the founders that we tend to back wouldn't really be interested in doing something that wasn't impactful.
I guess I imagined still, having that same impact, but having to do it a different way.
We make sure that it's broad enough for them to be able to move within that, for sure. That happens quite a bit, doesn't it? Especially in the first 2 or 3 years, the life of the company.
That's what I'm more thinking.
Still finding your product market fit. And we tend to come in when they've found that. So a little bit later.
Yes. Whereas we, as angels, we probably see a bit more
flex.
It's kind of like, if there's a meeting being called, you half expect to see a pivot, a proposal for a pivot. So but just as you were talking about that theory of change, though, as donating to not-for-profits, so funding not-for-profits, which is the other part of what I do. It's basically, I look for the same thing. So, but they need to, the indicators have to be fulfilling the mission, so that it's not revenue driven or whatever. It's just, how many people's lives have we changed in the way that we said that we would change?
We count things like that. Definitely.
So it's basically the same thing. And I know a good not-for-profit when they can show me their theory of change, and they can show me their KPIs, and if as soon as they've got that and they can present that, I'm like, okay, you guys have made a really good start here, and it really bodes well for mission fulfillment, because everybody's clear on what the mission is and how we reach it and how we measure it. So it's really important. So I think, what are we doing with time? So we've got a little bit more time, and then we'll go to questions. I might just round it off though, Zoe. All right, 2 quick things. Current trends and or reasons to be cheerful.
Current trends. I think everybody's seen a lot of climate tech. I'm noticing and hearing from lots of successful founders in other areas wanting to do something in climate tech and getting in touch, which is pretty smart to ask investors about this, because we see so many. They're trying to find the areas where there's gaps, because you can see a lot of companies trying to solve the same problems, and then when you speak to people who are on the ground in climate tech, or you look at the World Economic Forum and what they say are the biggest risks, there's ones that aren't being tackled. Everyone's going for the same ones. So it's nice to be contacted and have those conversations and see these experienced entrepreneurs start tackling such massive problem. So that, I think that's very, very exciting and a good reason to be cheerful. I also see a lot of my fellow female VCs becoming partners recently. It's really, really good. So check writers, which we need a lot more of, and it's happening. Now, I've only been in the VC world for 5.5 years now, but it's really starting to change. I've seen the people that are coming all the way through becoming partners. So this is exciting, and I think that's going to have quite a significant change around things and what gets funded now. So that's the other thing that I'm quite excited. There's still so much more to be done, much more. But yeah, those are the things. So climate tech, seeing a lot of safety tech too is emerging. So the cybersecurity and people looking at online hate, gaming, things that are really exacerbated by the pandemic. And of course, we all know what's happening with healthcare. I mean, in the UK at the moment, finally NHS had some money. And yes, it's a long overdue expenditure coming, and they're looking for all the startups out there to partner with them and some of the established ones. And it's fantastic because people used to say, "Ooh, NHS, oh, risky for investment." It's actually, there's some players now really going to do very significantly well out of the NHS now, very, very impactful and great for the NHS. So I'm excited about that.
Yeah, I am too, actually. The NHS ones, I've got a couple, or probably 3, I think, in my portfolio that, have targeted a need at the NHS and had the contacts and really were already enmeshed. And so, and have managed to sell, into more than one trust or whatever. So, I'm feeling quite hopeful about that too. Another thing I'm hopeful about, or that I like to see, is I haven't invested in a lot of it myself, but the growth of femtech but not just femtech, but just serving the needs of female customers. So whatever that might be, whether it's in health, whether it's in things like fertility or pregnancy or, menopause or whatever, all of these kind of areas biologically that have been overlooked. But I also think there's a lot of businesses that are coming out that recognise that women seem to be the primary caregivers for children and elderly parents or whatever. And so there's a lot of support for the juggle now. It's, so it's like making it easy to get childcare, or making it easy to, get holiday care, or whatever, those kinds of areas that have been overlooked as.
Yeah, we've got a few investments in those sectors. They're doing particularly well in Germany at the moment because they've started, there's new funding in Germany. A lot of the employers pay for these things.
Yes.
Yeah, it's really, really good.
So there's this whole sort of awareness of, okay, how do we attract good talent? Well, good talent maybe has a family, and that family needs to be looked after. And I've seen a few proposals come through as well in a similar space. It's like, and a lot of it's B2B, and they're selling to the employer, who then gives it to the employee, which I just think is fantastic. So reasons to be cheerful, definitely though.
Definitely.
Okay, so we better do some questions, I think. Let me see. So Sarah is going to propose the questions, and then whoever is the best one.
Right. I've been taking a note of them as you've been chatting, and thank you very much. That was a fascinating conversation, and I'm sorry to cut it off. We could have gone, but just quickly, a clarification question from me to start. So you were talking about a 2 to 3x overall return coming from probably two investments out of 20, and similar numbers, I think, for you, Jodie. So I just wondered, what are your ambitions per company that you invest in? You're obviously not targeting companies that are thinking about delivering a 2x return, are you? What sort of ballpark?
So for me, we'll look between 50% of the fund and the entire fund. So our stake, our stake, so it would be like 10%, I guess. By the end, we aim to hold on to 10%. So that means they are selling for between 500 million, the exits between 500 million and $1 billion. So it's fair. That's the size of the fund. That's what happens.
So 500 million
to $1
billion in terms of exits is what companies should be thinking about. That's really, really helpful. Do you have a number like that, Jodie, or is it little?
Well, not
we
really.
Don't have to.
I think things are pretty loose, but I'm thinking 10 times. If a business can show me scalability at 10 times, I'm pretty happy. Obviously, you predict more, and particularly those sort of B2B SaaS ones, you want them to just explode. But if something can show me 10 times, I'd be, you just need to see that there's potential there.
Great. And then there's a related question from Sanya asking, will your returns come exclusively from exits, or do you consider dividends or something else?
All exits.
Yeah.
Yes.
I mean, I think we, as angels, we see the world the same, because they're probably lower risk investments you could do if you want to see dividends. So just to balance that risk and return. Question from Emma. She asked, how can first-time founders who are currently bootstrapping both approach to and appeal to investors? So I think a question for both of you, really.
Well, I'll go first on that, because as a first-time founder, you're probably going to come to an angel after you've been through the well, not just like the bootstrapping phase, so putting your own money in and sweat equity and working your butt off. And if you've got a little bit of traction and a little bit of revenue and capital is constraining your growth, then you would come to an angel investor. So how to impress us, I think, to show those things that you have bootstrapped and got from zero to something that you can show us. So initial revenues, I think, like, that's probably enough. That tenacity that Zoe was talking about, we like to see that. So it's an early stage business, but it's going to be a really long road ahead. So to have the vision and to have the ability to stick with it, and the patience to get through the fundraising round, that's a bit of a red flag. If you're struggling to provide the information we've asked for and to be patient with us, then I feel like it's probably not a good match either. So to have do a bit of research about how angels work and understand how that first fundraise works would go a long way.
Yeah, and I guess for me, you might be a bit further on by the time you come to me, but what we're looking for, which is quite hard to do when you're doing the day-to-day as a founder, is to be able to articulate how you're going to change your industry, what is happening with all the industry players, so the bigger macro landscape, how you fit into that, and how you're going to grow to be that 500 million or a billion valued exit, how you're going to take that. And that's quite different from the day-to-day operating of a company. So this ability to move from strategic to operational is like a switch, and that you need to develop as a founder, and it's really hard, and it can take years to get into that, which is why some people say, oh, second time founder, oh good, because they've been through it and they've kind of learned that switch, because it is so hard to get. But that's what we're looking for, and always ask the size of the fund and fund return expectations, because then you get in a feel for how aggressive or assertive, what scale of company they're looking for you to build. Because it will be different with each investor. You might have to pitch the big ones, like for us, and then for a much smaller investor, maybe they've just got a 10 or 15 million fund, they'll be looking not so much on the big picture, but more, what's the next 12 to 24 months is going to look like, this different emphasis. Yeah, I find it, I don't see that many founders articulate the big vision plus how they're going to execute it and what all the moving parts are very well too often.
It's a lot.
It's very difficult to do that.
Yeah.
Right, we've had a question from Simon Thorpe, and this is for you specifically,
Yeah.
Zoe. Have you seen the impact investing landscape changed? Has the definition changed? And third bit of the question, intuitively, one would expect more female entrepreneurs creating impact businesses. And is that the case in your experience?
Okay, yeah, leading question, Simon. You know it's changed. You've been around for a while too. Yeah, he knows I've been around for like 10 years when I was raising. The impact when I raised was very much more on the philanthropic side. It did lean, it had lower return, the funds were much smaller. Ananda's fund, when they invested in me, was 22 million. It's very different return expectations, different types of businesses that they invested in at that point. And now the fact that we can raise a fund of this size, 110 million euros, shows how much has matured. People wouldn't put the money in with us if they didn't believe that impact and tech could not make the returns. It's the fourth fund, and that's always a tell, because you don't get to the fourth fund because it's like 10 years because you've exited one. So people know what you can do as a fund. So we've demonstrated that we can make those returns. That's been proven. There's other funds, Germany and the UK and the Scandinavians have been, coming out with some really large impact funds now. We're not alone. And that's something that we've noticed, that we were alone for so long, the biggest fund in Europe, but it's no longer the case. Things, you have to keep on your toes. It's great. Other people are keeping us on our toes. And people have noticed the maturity and the sophistication is different now. There's this difference between social finance and there's the impact VC. That's much more defined now. And, 6 years ago, I still had to go on calls like this and talk about the difference between the two. I think it's much more accepted that there's social finance for, for different types of businesses, and then there's impact VC. And we work alongside mainstream investors, very similar, slightly more patient capital, which means essentially that we don't have those 4-5 times expectations. It's 2 to 3, so slightly less pressure, but still a lot of pressure because of the size of the fund. So, and we're getting money, as we were explaining before, from different places now. It's the banks, it's not just foundations, ultra high net worth as it was in the beginning. It's institutional money. So they're seeing that they can get decent returns from this area as well. And so yeah, changed totally, Simon, and for the better. It's what we always wanted. And now we're just getting more mainstream VCs to come our way. That's it. I mean, it's fantastic for impact entrepreneurs as well. So definition changed, yes, as I've just explained. More female entrepreneurs. I mean, I, as a female myself, I do attract more female deal flow and diverse deal flow. It's not just female, it goes beyond that. So my deal flow is incredibly more diverse than most. I would say in healthcare, yes, more female entrepreneurs. In some areas of climate tech, I see more women in circular economy. I don't see them in other areas on the more B2B SaaS, which is where you get a lot of the scale. I see more women in the B2C and not as much in the B2B. And I'd like to see more women in some of the more B2B SaaS spaces in climate tech. I think that would be really, really great. So not as many as I'd like, actually. So yeah.
We'll see what we can do.
So just staying with the impact theme, we've had 2 questions that are a little bit similar, so I'll kind of put them to you together. But Kanika has said, do you need to work harder on driving commerciality with impact founders? And Galina has said, how do you support founders from an impact perspective?
Okay,
So
yeah, commerciality. We were talking about this today, actually. It's a mixed bag now. I'd say definitely in the past, yes, because it's been so mission driven. Just your passion's there, but perhaps not the experience on the commercial side, depending where these entrepreneurs came from. But now there's different beasts of calling entrepreneurs beasts, but there are different types coming through that have worked in other areas and now coming into impact. So it's getting a bit of a mix, and we've become better and at spotting that, and we will still support them, but put the right people around them to help them grow that area of themselves. So we've become better investors in doing that, because that in the past, that has been a strong trait, more mission than commercial, but not so much. It's a bit of a mix now. I think investors have got better at supporting that too. So what else? What was the other angle?
So it's how do you support founders with their impact?
So how do we support? So helping them identify those KPIs at the beginning. They're often ones that they've already got. So just scoping that. Do we do an impact mapping exercise, looking at that theory of change if they haven't written one already, which is just like a paragraph. It's not a massive piece of work. It's a statement. We don't do too much, but and then, yeah, crafting those KPIs that they feel comfortable with to report to us for the next 2 to 3 years. Because as the business evolves and they get more sophisticated, they'll be able to adapt and evolve those KPIs too. But we will give our investors the projections on what those impact KPIs are, and we are measured against that too with our fund. If we don't hit those impact KPIs, we don't get our carry as well. That's the test of a true impact investor. Is that you're impacted by the carry? So then your values are aligned.
Exactly. I think alignment of values is a really nice note to end on, and that's what we consider ourselves at Angel Academe to be, aligned with the founders that we invest in. So I'm going to have to wrap it there. There are a few more questions, but we'll try and get onto them separately and get back to people. But thank you so much, Jodie and Zoe, for your time and insights. You've given us a huge amount to think about. I've just got one slide to share with people about some ways to get involved with Angel Academe if you aren't already. So if you're a founder currently raising investment or about to start, then you might want to apply to pitch. There's a lot of information on our website about our investment criteria and how we work. If you're already an angel investor or like to be, and want to see how we roll, then please get in touch with Michelle. You can also subscribe to our newsletter on Substack and follow us on LinkedIn. And finally, we have a whole bunch of recordings of previous Investor Academe sessions on our YouTube channel, and this will go up there soon. So watch out for that if you want to rewatch it. So I think Simon is kindly adding some of those links to the chat now, so you can click through straight from there. But thank you all, everybody, for joining us. We finished bang on 6 o'clock. We're going to let you go and enjoy the rest of your evening. Thank you very much. Thank you again, Jodie and Zoe. That's wonderful.
Thank you.
See you soon.
Bye.
Bye.